Welcome to the Deployed Podcast, where strategy, ideas, and capital come to life.
Hey guys, thanks for joining me on another episode of Deployed. For those of you who don't know me, my name is Michael Kearse. I'm a real estate investor and fund operator. Over the years, I've worked with a wide range of investors who built very successful business professionals and operators in many different arenas, many of whom eventually start to ask the same question. Is there a smarter way to deploy capital, especially retirement capital, outside of the stock market? So on Deployed, I'm not here to pitch. I'm here to understand how successful people think about capital risk, long-term decisions, and to explore how tools like the self-directed IRA fit into that thinking. Today, I'm joined by Don Smith. He's a partner over at Venture Studios. He's doing some crazy things over there. They're building about 7 more companies. I believe they have 7 in the portfolio already. So I'm super excited to talk to him. How you doing today, Don?
Oh, fantastic. Thanks for having me, Michael.
Absolutely. Before we start talking investing, I love some context. So what is your path, or what did your path of success look like? How'd you get to where you are today?
It kind of looks like this.
Yeah, that's a great way to say. I like it.
Our team, we're 4 partners in a venture studio. And for those who don't know what a venture studio is, because most people don't, a venture studio is not venture capital. It's the operations group that partners with a founder who has an idea or a product or a service, and they don't know how to bring it to market. They don't want to learn how to be the CEO. They just they have their product and they need a team that can take it to market and scale. And that's what we do. So we'll partner with a founder. We're working with our newest one is an AI venture that's creating an encrypted vault, and he's been working on this product for 8 years, but the technology wasn't there until AI has made the leaps that it's made just in the last 6 months. So he came to us and he said, "Look, I've got this. It means a lot to me, but I'm not going to be the guy. Do you want to take this and run?" So that's what we do. We're rebranding, we're building out the rest of his MVP, and then we'll take that to market. So that's what we do as a studio. We bring in funding through angel networks that we have, and then ultimately when we get to Series A and whatnot, then you start talking to venture capital firms. For all of our partner portfolio companies that come in, they're almost all at pre-seed. They're pre-revenue. They've got an idea. Maybe they have an MVP. Maybe they've done a pilot or a soft launch, but most of them are still in late ideation. And so we go out to our angel networks and we say, we've got this opportunity. We've got, early access to this technology. You're going to get a really good return on that investment. And then we take that, whether it's the initial $250,000 or $500,000, and then we'll take that to seed, bring that to market, get our early traction, and then we'll go raise $1 million or $2 million round from larger institutional angels or smaller VCs. So that's how we build our portfolio, and we're now up to 10 companies. We brought in. Yeah, we brought in 2 in the last 2 weeks, and we're talking to a third that's about ready to sign with us. So we're growing like crazy. It's a lot of fun.
That's a unique niche. So how did you get into that? How did that happen?
So very quickly, I was an attorney, and then I got into financial planning, and then I went into mortgages and exited that during the great financial crisis. Wound up as a wealth management advisor at U.S. Bank for a number of years, and then joined a startup in fintech that was specifically geared towards reducing the risk in mortgage portfolios, identifying and reducing the risk in mortgage portfolios. And I was with that company for 10 years. I was a product owner for the Loan HD platform, which was the risk analysis platform. And I got an opportunity from a guy that I met. He was looking to build out a bunch of companies, but he was kind of a networker and didn't have any operations capability. And he said, "Hey, would you like to be my CEO?" I said, "Sure, let's talk about it when you get some funding." And eventually he got funding for a couple of projects, and he partnered me with another attorney who's in Northeast Mississippi, who's now one of my co-founding partner. And then we brought on somebody that he knew and we both love, who's in Huntsville, Alabama, a couple of years ago. And just 2 weeks ago, we added another partner here in Jacksonville who runs the Silicon Beach ecosystem, and the 4 of us are hitting the ground running. So it's my path personally has gone through not 5 different jobs or 5 different companies that I work for, but literally 5 different careers.
Yeah.
So I've been all over the place, and I've I've worked on deals of all stripes, including some real estate investing. I raised about $500,000 for a long-term options contract in Hillsboro, Oregon, where we're trying to bring in chip companies. But we started that deal in 2010, and it's basically a land use play. But some of the investors that we brought in actually used self-directed IRA money to fund that investment. So that was
That's awesome.
particularly cool.
That's awesome. That's awesome. Wow, that is interesting. So throughout your past, has your relationship with money and risk kind of like changed?
Absolutely. In my 20s, it was all about, how do I day trade, and I've done forex, I've done precious metals, I've dabbled in every get rich quick scheme that you can imagine, and you fail at those enough times and you're like, maybe get rich slow is the better way to go. And you know, my my personal holdings are diversified, and I've got some angel investments that I've done through my personal self-directed IRA. I've got some crypto holdings. I've got some stocks, but I'm not a stock market guy because I prefer uh, a little more direct access to my risk management. If you own a publicly traded company, you're on their quarterly earnings cycle. I prefer to invest in things that I can control the outcomes a little bit better on. So
Absolutely.
that's a big shift in my risk profile. Compared to my wife, I am extremely risk tolerant and she is extremely risk averse. So we have
Yeah.
different outlooks on that, but we have fun conversations.
Yeah. I appreciate that. Me and my wife are the exact same way. I'm more of the unorthodox guy, always looking for ninja hacks, and she's just straight up and down traditional. So, absolutely, the conversations are fun indeed. I can respect that. So, as you became more successful, did the way that you think about capital kind of evolved over time?
I think my capital, it's not so much as you become more successful, it's as you acquire more capital or you have more risk in play,
Mm,
management becomes more important. Return of your capital becomes more important than return on your capital in some cases.
that's
It's
right.
the capital evolution is, I think it's just a natural growth of, if I don't have any, then I'm going to risk everything, right? I'm going to try to double my dollar and make $2. And then once you've
Yeah.
got $100,000, you're not trying to double that on black, right?
Yeah. Yeah.
Where you might lose that $100,000. It becomes risk management at that point. So
Yeah.
that's really the fundamental shift, and it's not because I got more successful. It's just because I have more at risk uh,
Yeah.
in the world. You gotta,
Spoken like a true financial advisor. Yeah. But now
but
you're 100% right.
yeah,
Yeah,
yeah.
100% right. You're 100% right. What do you think separates people who accumulate capital versus those who like deploy it well?
I think there's a level of discipline in deploying capital well, and it's not like, it's a disciplined approach. I need to look at my buckets and I need to understand my overall goals. And this is all, typical financial planner stuff. Where it gets different is in looking at deploying capital. You look at your capacity to analyze the underlying asset that you're deploying into. And if you are a sophisticated real estate investor, great. Analyze those deals, be creative. And I'd love to talk to you about the options contract I created, or not that I created, but that we bought into for the Hillsborough deal, because it's really cool. But if you're next level in a particular asset, that's great. Analyze that asset, understand your risk, deploy your capital. However, that same guy or gal shouldn't be looking at, oh, well, I'm a sophisticated real estate investor, so I'm going to throw some money at a startup AI company that I don't understand the industry on. So deploying capital depends on your level of sophistication and understanding your underlying risk, and then bring on advisors or experts or partners who can complement you in the areas that you don't know how to deploy capital effectively and well. And that's a big difference. I talk to hundreds of angel investors a year, and there are angels that we don't take money from. I don't want your $25,000 check if you're going to call me every week and ask me when the launch is.
Hmm.
That's not how angel investing works. What I want from an angel investor is very different than I want from a real estate investor, and their skill sets are different, and their deployment of capital is very different.
Man, thanks for sharing that. Thanks for sharing that. A couple of things I want to reiterate what you said. So I have a partner. We've probably got about 14 or 15 properties now, doing well. He speaks Spanish, which is why I decided to partner with him. And he's at a level where he still wants to just go at it, right? I built a portfolio. I'm a little bit more laid back, right? And he brings this opportunity to me to buy a business. And it's like, they got all these machines, they got all this land, all this real estate. And I'm like, Dan, like, this isn't my lane. Like, I can see the opportunity is there that we could probably make a ton of money, but I know nothing about underwriting a business. I mean, I know enough to be dangerous, but we need to, or you need to find someone that can really, hold your hand or can, that it's an expert in that, right? I know my lane and what I do like the back of my hand. I can look at a property. I know how much money I'm gonna make. With that business, I got to take time to learn how to do that. So you're accurate when you say that, know your stuff. If that's your lane, stick with your lane and or partner with someone who's an expert in that. So maybe that's something that we could talk about offline because we've been looking for someone to kind of help him navigate that. I love how you said that. And then your other point, I've raised a little over 8 million and you are spot on. There's good money to borrow and there's bad money to borrow. Now when I sit down with a potential investor, uh, versus early on, now I'm asking them questions like, what are your goals? Have you lent on a deal before? What are you looking to accomplish? Right? What is your risk tolerance level? Because to your point, asking me every week where we are, what's going on, it's not a fun relationship for either party. So how do you personally think about risk today versus earlier in your career?
I'm still fairly risk tolerant. I'm still highly risk tolerant. I mean, I say this all the time. The hardest part of building a business is going from idea to the first dollar of revenue. And my genius plan was to do that multiple times at once across multiple industries.
Yeah, yeah, scale it. Yeah,
So my partners and I, we work really, really hard. And there are days where you're like, why am I doing this? And then there's weeks and months at a time you're like, you're on fire. Like, I can't tell you how on fire I've been in the last 2 weeks with the AI stuff. I have built for our internal use. I have built tools like I built a brand asset guide that allows us to upload information about a company that we're working with, and it'll spit out a brand guide. And then we can create a nice PDF of that, or we can feed that back into AI for brochure generation or pitch deck generation. Like, it's amazing what you can do right now. So I'm on fire. I'm
yeah, yeah.
loving
I
I'm
bet with
loving
the
that piece
AI.
of it.
Yeah,
It is
yeah,
sick what you can do today. And that, from a risk perspective, I love opportunities that have good multiple upside, and and I love a good sweat equity because that's kind of what our business is built on. But there is, and I mentioned this before, I'm not a stock market guy. I have been wrong for 15 years now on the stock market because after the great financial crisis, I mean, I was in the thick of it. That was my world. Real estate and mortgages was my world. And having come from the financial planning world, knowing the products that were out there and knowing how that advisory service works, I just thought, geez, the stock markets are, it's just a casino now with high
mm,
frequency trading. And you've got the mag 7, which represents the majority of all S&P revenues. So it's really like the S&P 493, and then you got the other 7.
yeah,
And I can't control it. I can't measure it. I don't know how to analyze the macroeconomics. And I used to think that I was smart enough to figure that out. And maybe that's the one thing that's changed, is life has humbled me. And when I say I was wrong on the market, it was, I just didn't invest in the stock market. So I'm like, it's gonna die. It's gonna collapse again. When they changed the market rules in 2010, and we hit that permanent bottom and just bounced right off of that, I'm like, it can't last. It can't
yeah,
last.
yeah, yeah.
And it's just been the little engine that could, and they just print money to make it work. So I'm like, I can't analyze it. So I'll just stay in the real estate deals that I've got, and the startup world that I'm in, because I can at least analyze that. I can talk to the customers that we're building products for, and And I know when that's working and when that's not. So that's my outlook on risk.
I love it. Yeah. I was never really a stock guy either. I try to dabble in it, but real estate has seemed to call to me and I'm having a lot of fun with it. What roles does liquidity play for you now, if any?
Liquidity is king. Cash is king. You know, the challenges that any business faces is cash flow management. And
Mm,
you know, for us, having when we go to price around, not price around, but when we go to determine what the ask is, you know, we're always building in a 20% buffer for what we're looking to raise or more, depending on the business, like how sure we are about the budget. Like we've got a consumer packaged good that we know the numbers on cold, so I can ask for exactly what we need. We've got another consumer packaged good that's just about to launch, so we don't know the unit economics on it yet, so we need a little bit of buffer. And then we've got others that we're still building MVPs. So we're building like 50% buffers because if I say I'm going to go raise $1.5 million, but I really need 1 million, and the million includes my contingency, I may not be able to raise $1.5 million. I may only be able to get in 750 or 1 million. So when we're looking for how much we're going to the market to ask for, we're building in all of those contingencies, and it really is deal by deal. You gotta analyze that.
yeah. No, I like that. And then at this stage, are there any investments that don't entice you or don't interest you anymore?
The all the trading, any sort of trading, right? You can either invest in the stock market or you can trade the stock market. And if
No,
you're if
yeah, I
you're
like it.
if you're buying companies with the intention of like Warren Buffett style, this is a company that I believe in and I want to own for the long term, that's an investment. If you're buying because you're hoping that the earnings is going to give you a little, you know, a 3% bump that you can then sell off, that's trading.
Trading,
I don't like trading. I want to underline own the
gambling.
underlying asset and understand it and just buy it, because trading is ultimately you may win 6 times in a row and then all of a sudden you lose half of what you got, or half of what
It's
you
the new
had to
casino,
start with. It
like
is
you said.
absolutely the new casino.
That's a great analogy. Now, and how do you decide if something is like worth your attention? Like, especially from the angel world. Like, how do you do that?
So for us, I'm on the other side of that. So we're not looking at companies to invest in. We're looking to companies that we believe in, that we can scale and that we can go find investment for. So we're a little bit different on that side of the equation. All of my angel money is fully deployed. I've invested some personal money in a couple of the companies that we have, and I've invested in a friend of mine. He's got a company that I put my self-directed IRA money into, and that's so my investment capital is fully deployed. What we're looking at now is when we analyze companies and we look at 2 or 3 companies a week who come to us and they're like, "Hey, can you help us?" And a lot of times there's not fit. Either it's the founders aren't the right fit for our model, or the founders are simply people we just wouldn't want to work with, even if they were, or their business isn't their business doesn't fit our thesis. We turn down. I mean, we've got 10 working, but we've turned down 30 or 40 at this point.
Yeah,
So
yeah.
just a lot of people that we're tight with our model. We're tight with our thesis.
That's awesome. That's awesome. Switching gears a little bit to the self-directed IRA. How did you first learn about it? How did that happen?
Well, because of the world I came in, it was kind of always in the background for me. I mean, when you're going through your Series 6 and Series 7, you learn about, you know, IRAs and stuff. You start to learn about those options theoretically, and then as I um, rolled out a 401k into an IRA, I'm like, well, I don't want to put this into a mutual fund. Like, what can I do here? And I found Acted IRA Group and looked at their website, and then I was like, well, what else is out there? And I found 3 others, and ultimately settled on one of the custodians, and rolled my IRA in, and just waited for an opportunity. And then one arose about a year and a half later. I was like, okay, let's deploy this capital. It's the right amount of money, and I like the opportunity.
Nice, nice. What surprised you the most about it once you understood how it actually worked?
Um, that's a little bit tricky because, like I said, it's one of those things that was kind of always there from the very start of me understanding. What surprises me most, frankly, is that less people do it.
Mm,
Like that
that's a good one.
that's
Yeah.
that is really the biggest thing, because It's not hard. And if you're doing, for anybody who's got a couple $100,000 or a couple of $1 million in retirement assets, and it's just shit sitting at Schwab, man, you got some real opportunities to deploy a portion of that capital in a meaningful way that fits your personal investment thesis. Most people, I think most people who've got large IRAs, that like that's their nest egg, and they're scared to mess it up. For those people, I would say, well, look, if you're buying an investment property, or if you're looking to secure some good interest income and you want to do lending through your IRA, it's not hard. I think people get intimidated because it feels like overly sophisticated or complicated. I think it's easier than you think. Like many things in life, I'm of the age where when I was 19, the Pentium first came out, the Intel Pentium, and I got this desktop computer. Actually, I had a 386. This is before Pentium. And I wanted to add a sound card to it. I was asking around, like, how do I do that? And somebody's like, you just open the box and you plug it in. I'm like, wait, what? Like, yeah, you just plug it in and you take this 3.5-inch floppy and you put it in the thing and you install the drivers. And I open it up. So I open up this computer, which I never would have thought to do. And it's a very organized motherboard with these cards in them. And I'm like, that's it?
That's simple. Yeah.
That's it? So a couple of years later, I'm building computers for friends and family, because at that particular time, it was cheaper to buy the parts separately and build them yourselves, right? And so that's what I was doing. And I was like, well, this isn't hard. And people are like, oh my God, you're a genius. And I'm like, yes, I am. So, I mean, and I learned to build my first startup was a software company, a web, 1997 or 8. I hand coded on Notepad a website called thelawclerk.com, and you just figured out the HTML codes, and it's not as complicated as you think. Now it's much more complicated today because the web doesn't work that way anymore. But at the time, it was just like, oh, I can literally open Notepad on my computer and deploy a website. Wow. And it's not because I don't have any technical training. I wasn't a computer science guy. I was curious enough, and I guess dumb enough, brave enough to just go try to figure it out. I think if you follow in the steps of people who have done that before, you show me the path once, I'm like, oh, okay, cool. And then now what else can I do? I think the people who have these IRAs, if they listen to people like you, if they listen to advice from people who have done it before, who can show them the way and assure them, like, look, the water's fine. It's not as difficult as you think. You don't need crazy SEC filings. You don't need an investment banker. It's self-directed. It's not that hard.
Yeah. That's just awesome, man. I love how you share that. What were there any types of investments that made the most sense to you inside the retirement account?
So real estate's obviously a good one. Lending against real estate. If you want to be a lender, let's say I've got $100,000 and a friend of mine wants to buy a piece of real estate and flip it. You do a hard money loan to them, percent, whatever you want to do, points and spread, or however you want to structure with them. And that accrues interest free in your retirement account. You don't pay income on that interest that you earn. And if you've got an opportunity to have flipped to a Roth, man. So real quick, I try to put my highest yielding stuff on the Roth side.
Smart.
And I put the slower growing stuff on the traditional IRA side, just because I get that Roth. Like, I take my bigger swings in the Roth, right? Because if I double my Roth, that's all tax free. If I double my traditional, that's not tax free. I got to pay income tax on it, and that's fine. But I take my bigger swings in the Roth IRA.
Yeah, I love that. Now I know that but some of our audience may not. Can you explain the advantages of the difference between the traditional and the Roth?
Sure. Roth IRAs are taxed when you put the money in, so you don't get the deduction. If you're doing IRA money, IRA contribution, pay tax on the, you don't get the deduction when you put the Roth in. On a regular one, if I put in $5,000 or $10,000 into a traditional IRA, I get a $10,000 deduction that year. On the Roth, I don't get the deduction, but all the growth in the Roth is tax-free. So my strategy has always been, in years where my income is higher, contribute to the traditional. Plus, you're stopped out. Like if you've got years where you're above. I don't remember what's that.
I think what is it, 7,500 a year?
No. Not the contribution limit. There's an income limit. It used to be like 120,000. I think the Roth contribution limit is much higher now. I don't know what it is. But if you're in a marginal tax bracket that's lower than the highest or lower than the bracket you think you'll be in retirement, put it in the Roth, right? Like if you've got one of those years where you took a big tax loss or your income was down, contribute to a Roth. If you can't contribute, you can convert part of your traditional into the Roth, which is something that I did a number of years ago. I had a traditional IRA, and I had a year where we piled up a bunch of tax losses because of the business that we're in. Like a lot of times we get tax credits passed through into our LLC, and it reduces my income quite substantially. So I had a year where we had a big tax loss. So I converted my entire traditional IRA into a Roth, paid that tax then, but it was much smaller than it will be on retirement. So
no, that's smart.
The Roth is pay the tax now, or you're putting post-tax money in. It's not like you pay additional tax to put the money in the Roth. You're using post-tax money to fund the Roth, but that's tax-free forever. The traditional, you get the deduction now, but you're going to be taxed ordinary income tax rates later.
Yeah. Thanks for sharing that. Why do you think retirement capital often aligns better with like passive investments rather than active ones?
Two big reasons. One, passive investing tends to be more stable. And when you're talking about retirement assets, these are the assets you're going to be looking to live on for the rest of your life. So you want to reduce your risk profile in those. Passive investing tends to be more stable in that regard. So you get slow and steady growth. Slow and steady wins the race. So that's the big one. And the other is just the management piece of it. Like passive investing is set it and forget it, or set it and check in on it occasionally. Whereas you don't forget it. Active management, requires more active management. So you got to be in there and on top of it. And a lot of people if you're planning for retirement, it means you're working really hard right now on your day job, your life, and your investments are a secondary consideration for you. There's a class of people that investing is their thing, that is their day job, that is their life. So active management isn't a problem. But for most people, they've got family, job, hobbies. Thinking about their investments on a weekly basis or a daily basis or even a monthly basis is just not what they want to spend their time on. They want to let it grow. So that's really the big key there.
Yeah. Thanks for sharing that. Is there a part of lending that appeals to you more than like operations?
Not to me. I'm the wrong guy to ask that question. I'm an operations guy. So that'll be one that I'll have to punt on, because obviously operating is how I add value to the world.
Absolutely.
I'm familiar with the lending side. I've done it, but that's not where I make my contribution to the world.
That's fair. What advice would you give someone sitting on a large retirement account who feels stuck in traditional options?
Well, I think what we talked about is understand what you have and what your goals are, right? If you've got $800,000 and you want to retire in 3 years and you want to draw out $100,000 a year, that's a little tricky. So you have to understand your goals and what your time horizon is to execute against those goals. And there's a whole traditional financial planning bucketing process that you can go through, and whether that's in a regular IRA or regular retirement assets, or a passively managed mutual fund or index funds, or whether you're looking at all or part of that in self-directed stuff, you still need to bucket. I've got my my long-term assets, I can take some bigger swings on the long-term assets. I've got my short-term assets. These are the assets I need this year. These are the assets I need from years 2 to 4. And those need to be safer, which typically means lower yield. But if you're looking at a portfolio and you're like, man, I really would like to take a 10, 15, 20% chunk of my portfolio, and my personal investment thesis is that real estate is the thing, or that startups are the thing, or that precious metals are the thing, whatever. Do that in your traditional, and take a chunk. Start small. Do 5% allocation to something. Understand how the self-directed IRAs work. Understand the fee and reporting structure. It's not that complicated and it's not that expensive. If you've got $10,000 in an IRA, a self-directed IRA is probably not for you. You're going to pay $300 or $400 or $250. It's a couple $100 a year to the custodian to manage to custody the assets. It's probably not worth it. But once you get to 30, 40, $50,000, $300 isn't that big a deal, and you've got full control over that. And you'd be surprised at what you can do with 20 or 30, $40,000, especially if you're doing lending on the real estate side. You're funding somebody's down payment on an investment property as a hard money deal. Great. That's a nice little 12 to 15% pop.
Yeah, absolutely. Well said. Well said. What kind of conversations do you think more investors should be having around retirement capital?
One of them is, in today's world, how do we properly diversify? Because diversification, if you talk to a typical Morgan Stanley advisor or your typical stocks and bonds advisor, they're going to tell you really need diversification is really important.
Hmm.
I recommend that you diversify against these stock. You should have this much in stocks and this much in bonds, and that's it, right? Because
That's why I
that's what
chuckle.
they get. That's what they get paid to manage.
Yep.
So diversification really means a lot more than that. It's looking at, where does real estate fit in your portfolio? Where do crypto or precious metals fit into your portfolio? Where do angel investments fit in your portfolio? And I would say that if you're somebody who's got, substantial six figures in your portfolio, or 7 or 8, it's really important to take a good look at what opportunities your money has to grow. And I'll say this, the reason they call them angel investors is because they're not investment return first. They are really supporting the ecosystem of entrepreneurs building something that matters. And what gets me every single day is the commitment that the founders that were around, whether they're in our portfolio or not. I mean, as I mentioned, we talk to tons of people, and one of our partners runs a pitch event every couple of months, and we see lots of entrepreneurs coming through, and they all have a passion to build something really meaningful in the world. So as an angel investor, if I can double my money but put something in the world that really deserves to be there, that's worth consideration. And
Hmm.
that's not necessarily the biggest ROI you can get. You can probably make a higher ROI in the world doing different things, but for a portion of your portfolio to be able to do something that supports your community, and whether that's supporting your local HVAC guy who's trying to get a start and buy his second truck, or your community in a broader sense, be like, hey, there's a company that's building something that's really, really interesting, and it needs to be in the world, and they need some support. I'll make money on that. That has to be part of the equation, but it's not necessarily the most money possible. It's being able to make a really good return on an investment that provides something back to the world, and that's our thesis. Our venture studio, Tanager Holdings, we call ourselves a 0 to 1 studio. We only bring on projects that are in a category defining stage. Like, our first product was a nasal spray that came out during the pandemic, and it was one of the first in its class. And now there's a whole bunch of them, Profi, and there's a whole bunch of them out there. But Convixel was the first in its class to be a nasal spray that would help stop that spread. Really novel, really innovative. Our first AI company that we brought on, they're doing real time security camera monitoring for jails. So his technology can not just detect guns or people or license plates or faces, it detects when people are being aggressive. And that's something that doesn't exist right now. It's a 0 to 1 technology. And that's really exciting. And in fact, right now, the founder of that is just about 40 minutes down the road installing Warden I1 at our first jail, St. Johns County here in Florida.
That's
And
awesome.
then 2 weeks from now, he'll go down to Flagler, which is the next county down. And so they're the first paying customers. So, we've taken that 0 to 1 technology and we've brought them to their first dollar of revenue. That's super exciting.
Yeah.
And those are the kinds of things that we build and we talk to investors who are interested in investing in.
Earlier I was going to ask you to define an angel investor because to your point, we hear that term all the time, but
Mm-hmm.
a lot of people don't really understand why they call them angel investors. So thank you for sharing that. How can someone get in touch with you if they are interested in being an investor or interested in learning a little bit more about what you guys do and want to deploy capital? What's the best way for them to get in touch with you, Don?
Yeah, so my email is don@tanager.holdings. That's no .com, it's just .holdings. .holdings is one of those new top-level domains, and hopefully we can plop that in the show notes. But this website up here, tanager.holdings, that's our website. We've got a contact form there. If it's easier, you can hit me at don@graycollar.com or don@visioncoreai.com or don@covixel.com. They all work. Those are just some of the companies that we've got that have easier emails to pick up. So you can reach me anywhere or hit me on LinkedIn, Don Smith, Tanager Holdings. I'm easily accessible.
Awesome. Awesome. Don, it was a pleasure. Thank you so much. For those of you watching live or those watching the recording, if this conversation resonated, share it with someone who's built success and is now thinking more intentionally about how to deploy their capital. And if you're curious about the self-directed IRA and how it can be used for passive real estate backed lending or maybe angel investing, you'll find some resources in the descriptions. Thank you for your time and thank you for listening.
Thanks, Michael.
You've been watching the Deployed podcast, where we deploy insight, capital, and growth.